Hello, everyone. My name is Keer Yang, and welcome to my paper presentation on improving convolution neural network-based stock trading by considering data heterogeneity and burst. This is a joint work with Guanqun Zhang, Chuan, Qiang, Guan, Hailu, Shuai, Xu. Okay, so here is the outline for today. First, we'll review the background and related work, and then we will talk about our main contribution, which is observing and validating the stock data heterogeneity and burst. And then we will go through the experiments and the conclusions. So stock market prediction has gotten a lot of interest in industrial and academic research over the last few decades because of the possibility for big rewards if stock market moves in the predicted direction. And different from investing in other markets, such as real estate and bonds, stock data is much more sophisticated due to its uncertainty and volatile nature. In recent years, there have been quite few attempts to construct automatic and intelligent trading framework based on historical stock price. For example, people use deep learning to do stock trading because deep learning is good at generating nonlinear model to fit the input data. However, there are only few attempts of implementing deep neural network for financial problems. For example, people have developed event-driven based deep learning model by extracting events from financial news text, representing events as vectors, constructing model. And they have also used the long-short memory or recurrent neural network to do stock prediction. And most recently, people also use a convolution neural network to do it by trading stock data as images. But all of this work ignored data heterogeneity and burst in stock data. Since our main contribution is developing a normalization method, we will also briefly reviewing the existing normalization methods in this table. So most common normalizations can be divided into 4 different normalizations. The first one is called batch normalization, which normalizes the mean and the standard deviation for each individual channel. And the second one is called layer normalization, which computes the statistics across all channels and the spatial dimensions. Therefore, the statistics are independent of each batch. And the third one is called the instance normalization, which is computed only across the features spatial dimensions. As a result, it is independent for each channel and the batch sample. And the last one is group normalization, which divides the channels into groups and computes the first order statistics within each group. And for details of each normalizations, you can refer to our paper. And our proposed normalization method does not belong to any of the category listed in this table. This is because we perform feature-wise normalization to preserve data heterogeneity and also rescale the data records in logarithm scale to suppress the impact of abnormal data. And now we will talk about our main contribution, which is observing and validating the stock data heterogeneity and burst. First, I will talk about how we generate our data. In particular, we consider 15 different time windows for each trading day. We will calculate 15 different financial indicators, and then we put them into a 2D matrix. For example, one of the indicator is called simple moving average, which is just calculating the average close price for each time window. And here is a visualization of the 2D matrix for stock data. And here is how we label the images. We will label each image as buy, sell, and or hold based on the rules here. So if the close price is lower than the first quantile of the 20 consecutive trading days, we will label the image as buy. And if the close price is higher than the third quantile, we will label the image as sell. Otherwise, we will label the image as hold. This data labeling method is also different from existing methods. The existing method will label the image as buy or sell if the close price is the lowest or highest in the 20 consecutive days, which will cause imbalanced data because there will be too many images labeled as hold. And now we will show the observation of stock data heterogeneity in features. So the heterogeneity can be explained as each feature vector obtained using a certain economical indicator, where a certain economical indicator demonstrates a specific financial pattern, and then no one is an exact copy of another. To validate this, we compare the 2D stock data with real 2D facial images. Clearly, as visualized in Figure B, each row is unique to other rows, and there is less similarity across rows. In contrast, the facial images in Figure A represents homogeneity across both dimensions. For example, the pixel intensity are similar in the area of a human cheek. So, and also by calculating the entropy for traditional 2D images and the stock data images, we can say that the entropy of stock data images are much higher than the traditional 2D images, which means that the stock data images are indeed heterogeneous. Here is the entropy. And we also use the chi-square test to validate the stock data's heterogeneity. In particular, we choose the significant value as 1%, and we set the null hypothesis as H0 and the alternative hypothesis as HA. And we let the first row to be the expected values and the other rows as observations. Since there are 15 observations in each row, the degree of freedom is 14, and this gives us a significant value of 29. And then we formulate the chi-square statistics between the observations as following equations. And here, as shown in the figure, the chi-square statistics are all larger than 29. So the null hypothesis will be rejected, which means that the observations across different indicators are heterogeneous. And now we developed our new normalization method based on the observation of feature heterogeneity. The common data normalization method are not suitable for convolutional neural network-based stock data analysis because they are applied on the entire input data. For example, this is a very common min-max normalization where X represents a whole image. And so we proposed our row-by-row normalization to preserve feature heterogeneity. Here, as shown in this equation, we use xi to represent one specific row in the constructed 2D stock data to do the normalization. And we also use a function g to suppress abnormal records. I will talk about the function g in the following slides. And now we will talk about the burstiness of stock data. As shown in this graph, the blue lines are the number of retweets and the red lines are the number of replies. We can say that the distribution for the magnitude of the social dynamics is right skewed. It's typically small, but can be occasionally very large. And also quite a few studies on social dynamics have identified the burstiness in social events. So we observe that the dynamics of financial indicators also show similar pattern. For example, abnormality in stock data is rare and has a burst nature, and it happens at a very low probability. And the normal data records are very common. Here, let's take the Costco stock as an example. We plot the data records and the histograms of the indicators called relative strength index, Williams percent R, and exponential moving average. We do plot these indicators for 447 days, and in particular, the upper panel shows the plot of the time series, and clearly the abnormal indicator records are all demonstrate a bursty nature. For example, short duration but higher value, and the lower panel shows the histogram plots. We can say that the rare events only happen in few days. So we can say that the stock data has a feature of burstiness. So here is the rare events. And it's been widely acknowledged that rare events will compromise the prediction of social trends and patterns, as they only have short duration and cannot describe the long-term characteristics of the social dynamics. For example, you cannot rely on these peak values to do prediction. And as a matter of fact, bursts in financial events are caused by events like war, natural disaster, and economic crisis, which are also very rare. And so we need to suppress the value of rare events, and at the same time separate the value of normal indicator records. So we use monotonically increasing concave function of G to rescale the original data. To ensure the non-negative, the data normalization will be calculated as the following equation. We will take the absolute value of H rho to avoid non-negative, to ensure non-negative. And this slide compares a normalized stock using both min-max and use both min-max normalization and our proposed normalization. Clearly, for H2D stock data, our proposed normalization leads to a higher entropy value, which suggests that we can promote the data heterogeneity compared with min-max normalization. And then now we will talk about the experiments. So our experiments will compare with other state-of-the-art approaches, such as the trading framework based on convolution neural network with min-max normalization, long-short memory, and linear regression with lasso regularization. We will consider 29 stocks, and we will do the experiments on 2 different evaluation criteria. The first one is computation performance, which is the prediction accuracy of various models, such as how well different classifiers distinguish between buy, hold, and sell labels. And the other evaluation criteria is financial performance, which evaluates the models by implementing real-world financial scenario, such as we buy, sell, and hold the stocks according to the predicted labels. we collect the data from 2005 to 2021, and we do the training on data from 2005 to 2015, and we will do the test on the rest 5 years. And here is our considered convolutional neural network architecture. We only consider 2 convolutional layers. After that, we use a max pooling layer of size 2 by 2. After flattening, we map the result into 128 vectors through fully connected layers. And then we map to the output labels through another fully connected layer with dropout. For all the features, we consider the size of 4 by 4. And we use precision, recall, and F1 score as evaluation matrix. Precision of the bi class is the ratio between the number of stock images correctly predicted as bi and the number of all predicted by. Recall is the ratio between number of stock images correctly predicted as bi and the number of stock image actually labeled as bi. And here is the equation for the F1 score. And we observe that the precision values for buy and sell are usually lower than that of hold, whereas the recall values for buy and sell are usually higher than that of the hold. This is mainly because of the fact that buy and sell labeled stock data are much less frequent than the hold. Therefore, it's difficult for convolutional neural networks models to learn the patterns of this stock data without compromising fitting the distribution of the input data. Similar phenomena has also been reported in previous paper. However, we are able to achieve higher F1 scores than previous paper because we have made the training and the testing data more balanced by considering the percentile of the stock price for each day in consecutive trading days. And now here is how we do the financial evaluation. So for each stock data in the testing data set, we will buy, sell, or hold it according to the predicted labels obtained by various models. We will start with $10,000 cash and the amount of stocks that worth $10,000. So we will have $20,000 as initial funding. For each day from 2016 to 2021, if it's predicted as buy, we will purchase with 50% of the cash. If it's predicted as sell, we will sell 50% of shares of that stock. And if predicted as hold, we will do no transaction. So here is our result. We record the multi-class prediction accuracy and analyze the returns of different models for all considered 29 stocks. We define the return of trading strategy as the increase of total capital at the end of 2021. The bold entries correspond to the highest return obtained by all frameworks. And clearly, for the most of the considered stocks, we can achieve the highest return in 5 years. It validates that by taking account of the data heterogeneity and suppressing the burst events, we can achieve more robust automatic stock trading framework. And here are the plots of time versus the assets we have. The right lines represents the convolutional neural network using our proposed normalization. And the blue lines are the convolutional neural network with min-max normalization. Green lines are the long-short memory framework, and the black lines are the linear regression. So in most cases, our framework has the best financial performance. For completeness, we post all our results here, and please check the paper for detail. But believe us, we achieved the best performance for most of the stocks. And so we observe that although more complex, the long-short memory-based framework does not have better results. And for some stocks, it makes no profit. This is because the constructed stock image data is small, and the long-short memory networks can easily overfit the training data sets. Long-short memory also consumes much more time to train, and the regression-based method has poor performance due to its model simplicity, which ignores the nonlinear relationship between the input stock data images and the output labels. So here are our conclusions. We analyzed the financial time series, which is calculated using different financial indicators, and converted them into 2D images. We observed the intrinsic data heterogeneity and burst in stock data. We developed a novel data normalization method in order to preserve such heterogeneity and control the impact of abnormal data entries. We verified the developed convolution neural network-based trading framework along with the developed data normalization method using 29 stocks and compare with the long-short memory and regression-based frameworks. Our framework not only achieves the better computational results, but it can also lead to a higher simulated assets in long-term training. And here are the reference list. And we have also open sourced our code. You can give it a try if you want. And thank you for listening.